Okay, so I'm here with Shauna Theriault, certified financial planner, CPA here at Wiser Wealth Management. Shauna is my go-to when I have detailed tax planning questions. And a question that we have already discussed, but got some interesting feedback on, was pilots that are doing the backdoor Roth. So mega backdoor Roth. Sorry, my mind just went blank there. The mega backdoor Roth. And we have a part one, which I guess we can link in the video, but this is part two. After we saw a few comments on our last video, I just want to kind of clear some things up. First of all, everyone thinks that you should be doing mega backdoor Roth and you should be saving all of your money into the Roth side of a 401k plan as an airline pilot. And our data is not supporting that. And I think why everyone says to do it, and I'm not talking about pilots who suddenly are experts at tax. I'm talking about even other advisors. There's advisors out there that even want you to convert everything now and convert your company match to Roth. Everything goes to Roth.
Right.
So first of all, when you do these calculations, you have assumptions, and your first assumption for the future has to be higher tax brackets to make that work. I disagree with higher tax brackets are here for the future. People think in terms of today. They don't actually follow tech and studies in healthcare and all these other things that are happening right now that are so cool that makes our workforce so much more efficient. Even here at our own firm, we're starting to use some level of AI to help us do tasks that in some cases are saving us 25% of our time. All these efficiencies allow us to essentially do more with the same number of people, which at some point eliminates having to hire other people, which creates profits. What do profits create? Taxes. So we definitely living in a world right now where there's this new technology age that's forming that may not be affecting the people that like pilots that are working right now in their jobs.
Yeah.
I think they see some of it. There's some form of AI that's out there and weather predictions and things of that nature, but their jobs are not more efficient necessarily because of AI directly. So maybe they're just not seeing it. But there are lots of situations right now where I believe that taxes could remain where they are, but certainly not go up to a 60 or 70% range like some people are calling for in the future.
Right.
The next thing is every family is unique. Every family has, if we built a spreadsheet for each client that's been through here, each one would be very, very different.
Yeah.
Pilots have military backgrounds sometimes, so they're getting pensions. That changes their future tax.
Completely.
They could be married to, pilots like to marry teachers and nurses. Both of those positions sometimes come with pensions.
TRS, yeah.
Right. So you have all these assumptions that might be really good for the guy next to you or gal next to you, but maybe not be good for you. And I get those text messages all the time from people. It's like, I flew with a person, this is what they're doing. It's like, well, that wouldn't work for you, and this is why. Or, hey, that would work for you, and we've been telling you this for 6 months.
Right.
So it goes both ways. So in our scenario, we have a $450,000 wage earner who happens to be an airline pilot who's getting the company match at 17 or company contribution at 17%,
right,
who has been saving well and has already accumulated $2 million in their 401k plan at the age of 50. And when we start doing these future projections, because typically, someone at 50, you would say you wouldn't do Roth, you'd do pre-tax because you don't have enough time to make up the difference. But when we do these future projections, we are seeing that it's still better to do your contribution pre-tax.
It is.
Versus Roth.
And I really think it boils down to the time value of money. Okay. And even if you are 50, so we're assuming in this scenario, they have 15 years until retirement. So 50 to age 65. So if someone's starting with 2 million pre-tax, we ran the numbers. And so if you're deferring your company, your company's putting in pre-tax, you're putting in pre-tax, currently assuming you're in a 35% tax bracket. In retirement, we're assuming a 37% tax bracket. The difference is that most pilots that come to us that are talking about this, they are saving to a taxable account in some manner, shape, or form. Right now, what we're seeing is they're doing this Mega Backdoor Roth, and maybe they're doing Roth contributions of their own, but then they're also converting the employer contributions, right? And that's an option now, even a Delta. And so they're doing this, and now they're making withdrawals from a taxable account that they're saving to. And so it's really, if you think about the money that you are withdrawing from your taxable account to pay the taxes on that, okay, but then also the taxes that you're paying up front because you're not getting a tax deduction today with pre-tax, you have all of that money year over year that is not growing for you. Okay. And the time value of money, I can't stress enough. So there's a cost there. And most advisors or softwares are not looking at that cost. Truth be told, if I simply say, I'm going to save, $70,000 between my contributions and employer contributions to a Roth versus a 401k, it's always going to show that the Roth looks better. Always in that scenario, because what's not being taken into consideration is what is it costing you up front and what are you not saving to? Because most of the pilots that we talk to, they're not spending the difference. So in other words, if they were to do pre-tax and their paychecks are higher, they would be saving more to a taxable account, and they would not be withdrawing money to pay the taxes on the employer conversions. Okay. And so if you take into consideration what you're saving up front, even if you're in a 30, so I ran this thing, assuming that I ran different scenarios. Assuming that, you retire at age 65, you roll that to an IRA, still growing tax deferred, or if it's a Roth, growing tax free. I looked at doing Roth conversions. Typically what we recommend for you is, from 65 to age 75, when you have to start taking required minimum distributions, that we do some level of conversions during that time, knowing that and I'm speaking in generalities. This is not the same for everybody. It depends on your situation. But, generally we start taking Social Security at age 70. So maybe that changes a little bit, but, we look at doing Roth conversions during that time. So even building that out where we're doing some Roth conversions during that time period, because that taxable money has had time to grow, and this is all growing tax deferred, your wealth at the end of it, even taking into consideration required minimum distributions at the 37% tax bracket, it still shows that your overall wealth is higher and doing pre-tax, the ending number.
So I think to summarize that, people are not taking into account that to put money into a Roth, you have to pay the tax. And we meet people all the time that are trying to save money outside their plan in order to pay the tax bill now.
Right.
Well, what if you did that pre-tax and the money that you were going to spend on tax actually gets invested?
Exactly.
And that money being deferred over this long time period is what the difference maker is. And even our own planning software does not take that into account.
No.
Some people say, oh, well, pilots are never going to save the difference. That might be a true statement in that world, but when you're coming to a wealth management firm, I would say almost all of our clients are big savers.
Yeah.
So they're definitely saving outside the plan. As far as Mega Backdoor Roth, I think that's great for if you're trying to catch up. If you flew during my decade, you're probably still trying to catch up from poor contracts and poor wages. But especially if you're a younger pilot, you may actually want that money to be in a brokerage account.
Yeah.
Because once it's in the backdoor Roth, it's a lot harder to utilize. We call it opportunity money. This money that's not necessarily attached to retirement, because honestly, 18% of what you make going into a plan, and plus you maxing the plan out yourself, then going into the market-based cash balance plan with the overages, your retirement's probably fine. You don't really need to race the company to do a Mega Backdoor Roth. But what you might need is free money, or money that you can actually leverage in the future. So in a brokerage account, you can do things like direct indexing. If the brokerage account gets large enough, you could actually do lending. You leave the money invested growing for you, but you could borrow against it. We have.
I prefer that over being your own bank and a life insurance policy. I don't,
Yes. That could be a whole nother episode.
It is.
Your bank life insurance policy is pretty poor.
But I like the brokerage money. It's cheaper and it's your money.
We've had clients, obviously more wealthier clients, but we've had clients borrow against that to build homes. Then they sell their home and then their old home, and then they would just pay it off. And it's a lot. It's more, I wouldn't say it's cheaper because there is an interest rate associated with it, but it makes life easier for them that they don't have the stress of having no place to live while something else is being built. So anyway, it could be used to buy a second home, down payment on a second home in the future. I mean, there's a million things you could use it for.
Well, and the biggest thing too is gifting, because, when we're running these projections, especially if you've been a pilot, for a long period of time, you are creating significant wealth that you may not spend in your lifetime. So if you want to start gifting in your lifetime to heirs, you can't do that from a retirement account.
Right.
You'd have to take a distribution to do that. You can't gift your retirement account. Now, you could argue, well, I can take a distribution from my Roth and gift that way. Well, sure, but that defeats the purpose of putting in a Roth to grow tax-free. So you paid all this tax up front. Are you really growing the family wealth?
No, that's not what the data shows.
Right.
In the end. So some people may just feel better if you sleep better at night, knowing that you're saving that way. Then maybe that's what's best for you.
And if you're not going to save the difference, then it does make sense to do a Roth.
And that was my next point: is if you're actually not going to save additional money that you would have paid in tax, then it is better. It does look better to do Roth the way that everyone keeps talking about. But even then, I would argue it's still apples and oranges because you're just paying the tax now.
Right.
Right.
And I don't think converting the employer contributions on top of you doing a Roth, you're not getting a tax deduction. And then on top of that, you're paying to convert the employer funds, because you can do that conversion. You can move it to a Roth, but you're going to pay that tax bill come April. If you just think of how much money that is year over year compounding that's not working for you, it grows to a high amount.
Yeah. Right. So I think that the takeaway here is that every family is going to be unique and different. And when you do your own planning, you need to make the calculations more apples to apples and understand that what you're paying in tax is money that could be invested. And you do have this decade between age 65 and age 75 where the required minimum distributions start, that you could be doing some massive conversions during that time period. And so those are things to be thinking about. And obviously we have to pay attention to the tax code. This last election has probably solidified low taxes for the next 4 years for sure. After that, hey, there might be a reset if they don't make it permanent, but we don't know that. And there's been so many times people have lost out because they assume things are going to happen in the future.
Yeah.
Not to digress from this specific topic, but if you think about like the U.S. bond aggregate index, so that's U.S. bonds. Everyone said, hey, I just want to be really short-term bonds after the financial crisis. And it took almost 20 years for inflation to actually happen. And you missed out on a tremendous rate of return in the bond market because you were too conservative for too long.
Right.
And so because everyone had the assumptions that things were going to happen, and it did happen, but you would have made more money just riding out through 2022 and taking a big loss on bonds and had higher rate of returns for all of the years prior to that.
Yeah.
So we have to be really careful. We're actually working on a podcast series that will come up later in the next month or so, but it's a 2-part series on behavior. So investing in your behavior. And I think this goes along with that is a lot of people have taken a couple of data points and they assume everything else. And there's so many data points they should be taking into account, but it's a human bias that we naturally have, and we have to fight against that when we look at something.
Yeah.
And also too, if we hear it enough and we see it enough, eventually we believe that it's truth, and that's not always the case either.
Right.
Truth could be very different from what you perceive truth to be. We see that in politics all the time. See a bunch of memes, and all of a sudden you believe this is true, and in reality, it doesn't actually work that way. So I would say, be careful in your assumptions. And certainly our firm here does a lot of flat fee planning for the airline industry, and we're happy to figure this out for you exactly your family situation and not just a general statement. But just just remember that there's always more data points that you should be looking at, not just maybe the 2 or 3 that you're presented with in a group chat that of people who may or may not be correct.
Yeah.
All right. Thanks, Shauna.